What is a SPAC, Special Purpose Acquisition Company, and how does it work? A Special Purpose Acquisition Company, SPAC, is a unique type of publicly traded company formed to raise capital through an initial public offering, IPO, with the sole purpose of acquiring an existing private company. Here's an overview of what a SPAC is and how it operates. 1. Formation and structure. Purpose. A SPAC is created specifically to raise funds through an IPO to acquire a privately held company. Management. Managed by sponsors or founders who are experienced in a particular industry or sector. Publicly traded. Listed on a stock exchange, allowing investors to buy shares before the acquisition target is identified. 2. IPO process. Capital raise. The SPAC raises capital through an IPO by selling shares to investors. Trust account. Funds raised are typically held in a trust account until the SPAC identifies a suitable target for acquisition. 3. Acquisition phase. Target identification. After the IPO, the SPAC has a limited timeframe, usually 18 to 24 months, to identify and acquire a private company. Due diligence. Conducts thorough due diligence on potential acquisition targets to assess their financial health, growth prospects, and fit with SPAC objectives. Negotiation and approval. Negotiates terms of acquisition and seeks approval from SPAC shareholders. 4. Merger or acquisition. Public listing. Upon completion of the acquisition, the private company becomes publicly listed through the SPAC, avoiding the traditional IPO process. Shareholder vote. Shareholders vote to approve the merger or acquisition, providing transparency and alignment of interests. 5. Investor considerations. Risk and return. Investors in SPACs face risks associated with investing in early-stage companies and potential market volatility. Upside potential. Potential for significant returns if the acquired company performs well post-merger. Redemption option. Investors may have the option to redeem their shares before the acquisition is completed if they disagree with the chosen target. 6. Benefits of SPACs. Efficiency. Faster route to becoming a publicly traded company compared to traditional IPOs. Access to capital. Provides capital to private companies seeking growth opportunities and access to public markets. Flexibility. Allows for creative deal structures and potential synergies between SPAC sponsors and acquisition targets. 7. Challenges and considerations. Market volatility. SPAC stocks can be volatile, especially during the acquisition phase. Regulatory scrutiny. Increasing regulatory scrutiny regarding transparency, investor protections, and governance practices. Performance risks. Success of SPACs hinges on the performance of the acquired company post-merger. Conclusion. SPACs have gained popularity as an alternative pathway for private companies to go public, offering flexibility, efficiency, and access to capital. While they provide opportunities for investors and companies alike, SPACs also pose risks related to market volatility, regulatory compliance, and performance uncertainties. As the landscape evolves, ongoing scrutiny and adaptation of regulations are crucial to ensuring transparency and investor protection in SPAC transactions. Understanding the mechanics and implications of SPACs is essential for stakeholders navigating this dynamic segment of the financial markets.